Welcome. We want to thank you for dedicating your time to go through the USDA Lender Recertification course today. Every 2 years, it's essential for all approved lender staff to complete this training for the Single Family Housing Guaranteed Loan Program. In this course today, we will cover important program requirements and discuss some significant updates that have occurred in the last year. Once you've completed viewing this training course, you can access the required knowledge quiz through the link provided by USDA to your organization's point of contact. You must receive a passing score to consider this training complete. Before diving into today's presentation, we'd like to take a moment to express our gratitude to you, our lending partners. Your commitment to providing affordable options for rural homebuyers and offering personalized support is invaluable. Working together, we can empower individuals and families as they embark on their path to homeownership. If you are new to USDA's Single Family Housing Guaranteed Loan Program, we welcome you aboard. We hope you've had a chance to check out our new lender training available in the USDA LINC Training and Resource Library. If you haven't yet, we recommend watching those training videos before starting this recertification course to gain a more thorough understanding of the program. Simply scan the code here to access the lender training section of the LINC Training and Resource Library. Today's training presents an excellent chance for us to address factors that might be stalling your file reviews. It's crucial to pay close attention to these important points and ensure that everyone involved in processing your guaranteed loans is informed about these potential challenges that could be causing delays in your conditional commitments from USDA. During today's training, we are going to focus on the key topics listed here. There are many reasons that the USDA Single Family Housing Guaranteed Loan Program is the number one choice for many lenders and homebuyers. Let's take a look at the key benefits. Rural areas often face unique challenges when it comes to accessing affordable housing and home loans. Limited housing options, lower income levels, and fewer lending opportunities can make it difficult for individuals and families to become homeowners. Our guaranteed program is specifically tailored to address these needs. We work closely with our lenders to understand the specific requirements for the rural areas we serve. With no down payment requirement, flexible credit requirements, no maximum purchase price limits, homebuyers have access to affordable financing. This empowers individuals and families to achieve their dream of homeownership. As a lender, you have the power to shape the lives of individuals and families by providing them with the opportunity to secure a home loan. By partnering with USDA, you can expand your reach and make a positive impact in the communities you serve. Because with our guaranteed loan, you are getting a 90% guarantee, and mainly due to their low prepayment rates, USDA loans receive premium pricing on the secondary market. And another great benefit is that USDA loans count towards CRE credit. Our guaranteed loan program team consists of highly skilled policy writers, loan reviewers, and training specialists. They bring a wealth of knowledge and experience to the table and provide the support you need. Next, we're going to take a look at the loan fees for a USDA guaranteed loan and eligible loan purposes. You might wonder how we sustain and support the operations of the Guaranteed Loan Program. It's not through taxpayer dollars, but lies in our fee structure. Our loan fees allow us to operate as a budget-neutral program and also allow us an opportunity to modernize our technology systems, making the loan process as streamlined and efficient as possible for lenders. A USDA loan can be used to acquire an existing property or to construct a new property. There are no limits on the amounts of gift funds, but contributions from sellers and interested parties are limited to 6%. Rehabilitation and repairs can be part of a purchase, but there is no product to renovate a home the applicant already owns. While we allow refinances of USDA's existing rural development mortgages, there are no allowable circumstances for cash-out refinances. And of course, Funding can be used for closing costs and customary purchase expenses. Let's discuss the refinance options in more detail. As noted earlier, only loans that are currently financed or guaranteed by USDA qualify. For all three refinance types, the Streamlined Assist, Streamlined, and Non-Streamlined, there are some key requirements. The existing loan must have been closed at least 180 days before requesting a conditional commitment and must have no defaults within that 180-day period. It must have a fixed interest rate with a 30-year term, and the household must meet annual income limits. Cash out from collateral equity is not allowed. Borrowers can only get back eligible prepaid closing costs and any escrow overages. Additionally, borrowers must live in the property. And for properties now in areas considered ineligible, those can still be refinanced. Finally, any existing leverage loans or subordinate liens must be fully paid off or subordinated. The Streamline Assist option is the most favored and effective refinancing choice. This is because it does not require a new appraisal unless the borrower has a USDA direct loan with recapture subsidy due. One limitation with the Streamline Assist, though, is that only deceased borrowers can be removed. If a living borrower is looking to be removed from the loan, the remaining borrower must choose between the streamlined or non-streamlined options. When reviewing credit history, Streamlined Assist only requires verification there have been no delinquencies greater than 30 days within 180 days prior to loan application. Streamlined and non-streamlined will also require a full credit review per Chapter 10 guidelines. All options allow refinancing of the principal and interest balance, eligible closing costs, and upfront guarantee fee. If the borrower is looking to include subsidy recapture, the non-streamlined option would be required. All refinance options will be entered into GUS and have supporting documentation uploaded to the application. However, due to the limited loan information available for a Streamlined Assist loan, you will not be able to process a final submission in GUS for these loans. You must follow the guidance in the Manual File Submission Process Guide for Streamlined Assist refinance loans. We will discuss submitting manual files according to the Manual File Submission Job Aid later in the presentation. Now let's take a look at the key requirements of applicant eligibility. The first key component of applicant eligibility is determining if the applicant currently owns a home, and if they intend to retain that home, are they eligible for a USDA guaranteed loan? A borrower can retain another home, but the following apply. They can only have one loan with rural development at a time. They must qualify financially to own more than one home. The home being purchased must be their primary residence. The other home no longer meets their needs, such as the need to relocate for work, a larger home for their family, or other acceptable situation. While we have provided a few examples, they do not represent every possible scenario, and it is the lender who will make the final determination as to the acceptability of any rationale. This must be documented in the lender's permanent loan file. Applicants must undergo a standard review for qualification. So what does this mean? It means you will compare the loan terms and borrower eligibility of a USDA loan with a conventional loan. If this review determines the applicant would be eligible for a conventional loan with similar rates and terms of a guaranteed loan, the applicant may be ineligible for a guaranteed loan, as this review suggests they do not need a guarantee to obtain an affordable home loan. It's important to note that this comparison does not apply to FHA or VA loans. Applicants can be eligible for a FHA or VA loan and still obtain a USDA guaranteed loan. The guidance on this slide applies to conventional loans only. Lenders must carefully examine asset accounts. It is important to ensure that assets are not moved between personal and business accounts. These accounts should be treated as separate financial tools, one for personal use and one for business use. If assets from both accounts are mixed together, the combined assets will be considered in the credit assessment. All borrowers must be run through SAM.gov to confirm they have not been suspended or debarred from participating in federal programs. If they have, they are not eligible for a USDA loan. Further guidance has been provided in Chapter 8 regarding applicants that have been excluded from a non-housing federal program. Keywords here are excluded in non-housing federal agency. Applicants that have been excluded from a non-housing federal program continue to be eligible to participate in the Single-Family Housing Guaranteed Loan Program unless the individual becomes suspended or debarred pursuant to the CFR. Applicants that are excluded from federal housing programs or excluded from all federal programs are ineligible to participate in the Single-Family Housing Guaranteed Loan Program. Once run through SAM.gov, you will fill in the information on the additional data screen in GUS. Fill in the date SAM was checked and whether the borrower has been debarred from doing business with the federal government. Note that checking yes to this question will return an ineligible response in GUS as it's indicating that the borrower has been debarred from doing business with the federal government. If they haven't been debarred, make sure to select no. To be eligible, the applicant must be a U.S. citizen, a U.S. non-citizen national, or a qualified alien. Legally admitted non-U.S. citizens will have a U.S. CIS number. If that number is missing or unknown, the applicant should contact the U.S. CIS. For all file submissions, the lender is responsible for documenting the applicant's legal residency. By submitting the request for a conditional commitment to the agency, the lender represents and warrants that the applicant is legally present in the United States and meets the eligibility requirements. If you need assistance with determining eligibility for non-U.S. citizens, visit the LINC Training and Resource Library and open the document Job Aid Eligibility for the Single-Family Housing Guaranteed Program. This resource provides guidance to help you make an accurate determination. Now let's take a look at income eligibility. As you know, this is where our program is unique. We have two calculations of income. One calculation to determine program eligibility with annual and adjusted annual income, and then one to determine borrower purchase qualification with repayment income. So first, the approving lender would determine the annual household income, which will include analyzing the income of every adult member of the proposed household, regardless of their participation in the loan. Next, you can subtract any eligible deductions to determine the adjusted annual income. So this calculation does not apply to just the borrowing members of the household, but to every adult who will be living in the proposed property. The resulting adjusted annual income calculation will need to demonstrate that the household does not exceed 115% of the median household income limit. Once that calculation is made to determine eligibility, then a separate calculation is performed to determine repayment income, which is the income of the borrowers only. The repayment income calculation is the type of process that all programs utilize to determine repayment ability and affordability for an applicant. You can access USDA's current income limits on the USDA eligibility site. These limits are updated annually. Now let's move on to an overview of income types, starting with annual income. Annual income encompasses the earnings of all adult members of the household, not just those who are note signers. For adult full-time students who are neither the applicant, co-applicant, nor the applicant's spouse, only the first $480 of their income should be counted. If the applicant and their spouse have been separated for at least 3 months for reasons unrelated to military or work obligations, their income can be excluded from the annual income total. Additionally, for adults in the home who are unemployed but actively looking for work, their past earnings should be included. However, if they are not seeking employment, their previous earnings do not need to be factored in. Let's review what counts as annual income. This includes the total of base wages and salaries, overtime, commissions, tips, bonuses, housing allowances, and any other payments for personal services. Also, add any income from self-employment or rental properties. If there are losses from a business or rental, these do not reduce your income. They are treated as zero. Include any court-ordered payments like child support, alimony, or guardianship payments. Don't forget to add any regular retirement or pension payments. Government benefits and long-term disability payments should also be included. If the household non-retirement total assets are $50,000 or more, you need to include income from those assets as well. We will go into more detail about this later on. Also note this list is not inclusive. Please take time to review Chapter 9 in the Handbook to learn how additional types of income are treated. Now, it's important to note that there are a few types of income that are not included in annual income. Those include, but are not limited to, foster income, live-in aid income, lump sum or sporadic payments, medical reimbursements, MCCs, Section 8 vouchers, SNAP benefits, student loans, GI bills, and unreimbursed employee expenses. As mentioned, the adjusted annual income determines if the household is eligible for a guaranteed loan. So let's take a look at that next. So let's take a look and get a quick refresher on what those eligible deductions include. Households can get a $480 deduction for each qualifying dependent, including those in shared custody situations. Another deduction is for verified child care costs for children 12 and under, based on expected expenses for the next year. Households with elderly or disabled members can also deduct unreimbursed medical costs that exceed 3% of their annual income. Likewise, households with disability expenses that exceed 3% of their annual income may also deduct those expenses. Finally, if the applicant or co-applicant is 62 or older, there is a one-time deduction available. We have now looked at annual and adjusted annual income to check if a household is eligible for the program. Now, let's examine repayment income. This helps us see if the applicant earns enough to pay back the mortgage along with any other debts. Keep in mind that repayment income calculations usually differ from those for annual and adjusted annual income. For repayment income, you should include reliable and consistent income that can be documented. This helps show not only past earnings, but also helps the lender assess the chances of this income continuing for at least 3 years during the mortgage. All income sources need to be documented. Lenders must look at any gaps in employment to decide if the income is stable and dependable. The agency does not set specific rules on what counts as an acceptable employment gap. It is up to the lender to review the employment history and determine stability. Keep in mind that the lender is the underwriter, while our agency checks the files to ensure they comply with our rules and standards. Some basic guidance for repayment income eligibility is a 1-year history for most base wages, bonus, commission, overtime, secondary employment, and so on. A 2-year history is required for most self-employment scenarios, seasonal, unemployment, and expense allowances. Child support and alimony would require 6 months. Now let's take a quick look at ineligible repayment income sources. This list would include, but is not limited to, foster income, lump sum payments such as inheritances or insurance payments, non-occupant borrowers, SNAP benefits, and any kind of unreliable or sporadic income such as gifts. Again, for a more detailed list, please refer to Chapter 9 of the Handbook. One main reason for delays in conditional commitments, as stated earlier in this training, is missing or incomplete income documentation. So let's explore some income documentation problems that could be affecting your loans. We feel that using real-life scenarios is a great way to understand our policies and regulations. So in this training, we have added some fact or fiction statements. Here's the first one. Since the income calculation pages were taken out of Form RD 355521, lenders do not have to document adjusted annual income, and repayment income calculations anymore. Is this fact or fiction? That is fiction. Lenders are still required to document adjusted annual and repayment income calculations in their permanent loan file. Lenders may utilize Attachment 9B, Form 1008, or an equivalent. Submission of the lender's calculations is only required on manual submissions, and thus refer with caution and accept full documentation recommendations. One key part of verifying and documenting income is the IRS transcripts. These transcripts help ensure that all income and asset earnings reported to the IRS are shared with the lender. Lenders need to obtain and check these transcripts before closing the loan and keep them in their permanent loan records. If tax transcripts are not received before closing, it won't hold up the loan closing, but they still need to be obtained and kept with the lender's permanent loan records. If the transcripts reveal any previously unknown or undisclosed income or asset sources, the lender will need to review this information further, which could affect the loan's eligibility. Our policy team has created an excellent resource that outlines various income types and their impact on annual and repayment income calculations. Please take a moment to review Attachment 9A. One of the main reasons files get delayed during the USDA review is due to missing income calculations or discrepancies between the calculations and the supporting income documentation. Additionally, if the lender's income calculation doesn't align with the entry in GUS, it can cause issues. So be sure to verify your figures before submitting your final application to USDA. Here is a way to approach your income analysis and documentation. Be precise in the details. Refer to the numbers as they appear in the supporting documentation. Make sure to record your calculations clearly so that anyone reviewing your work can easily understand how you determine the income. Non-retirement household assets that exceed $50,000 can influence annual income and consequently eligibility for a guaranteed loan. Therefore, it's important to examine how asset income is determined and the proper way to document household assets. Here's our next fact or fiction statement. If an applicant does not need funds to close, assets must still be verified. Is that fact or fiction? That is a fact. Assets must be verified whether they are required for funds to close or not, as assets may affect income eligibility and applicant eligibility. When the cumulative net family assets, non-retirement assets, exceed $50,000, those assets must be reviewed for annual income purposes. Lenders must review asset information provided by the applicant and household members at the time of loan application. Net family assets with actual earnings will use the stated rate of interest to calculate annual income. Net family assets that do not earn interest will use a current passbook savings rate to calculate annual income. A current passbook savings rate can be verified through the lender's personal banking rates, online website, or other applicable sources. For clarification, net assets means assets that will still be possessed post-closing. For example, if a household currently possesses $60,000 in non-retirement assets, and they will be paying closing costs of $15,000, that leaves net assets of $45,000, and therefore would require no further calculation for income purposes. Lenders do not have to list assets on the loan application or the asset and liability section in GUS. They can process the loan or get an automated underwriting decision without considering assets as a compensating factor. However, if the assets exceed that $50,000 threshold, the income from those assets must be included in the income calculations sent to USDA and on the GUS eligibility page. Keep in mind that GUS Accept files do not need income calculations submitted to USDA. It's also important to note that asset verification is still necessary, even if the amount is below the threshold that requires it to be included in GUS. It is crucial that assets are not overstated when using GUS or manual underwriting. Overstated assets can lead to incorrect GUS underwriting recommendations, invalid compensating factors, wrong annual income calculations, and possible fraud. If assets are inflated or miscalculated to get a GUS Accept recommendation or loan approval, it can affect the validity of the loan note guarantee and loss claim payments. This is an example of when and how to calculate assets to be included in the household annual income. This applicant has a non-interest-bearing checking account with a balance of $17,000, as well as a savings account that earns 0.25% interest annually with a balance of $24,000. The applicant also has a certificate of deposit that earns 3% annual interest with a current balance of $15,000. The applicant will use $5,000 from checking towards the purchase of the home. The total of all eligible non-retirement assets is $56,000, minus the $5,000 that will be used to purchase the home, bringing the remaining balance of assets to $51,000. This is more than the $50,000 threshold. Therefore, an income calculation is required. Continuing with the example from the previous slide, the checking account is non-interest bearing and will have $12,000 remaining after closing costs are deducted. We will assume the passbook savings rate for this example is 0.25%. This results in $30 of interest. The savings account is earning 0.25% interest, which equals $62.50 of interest. The CD will earn $450. Add these calculations together, and you get $542.50 of interest income that must be included in the annual income calculation. Again, the calculation is not required to be shown on the 355521 and not required to be uploaded to GUS for any GUS Accept ones. However, the income calculation should always be retained in the lender's permanent loan file, and the calculation is required to be provided on any GUS refer with caution, or manual underwrite. When entering reserves into GUS, make sure they don't exceed the balance shown on the most recent official monthly bank statement. Lenders do have the option to use a lower balance if they prefer. The next key topic we're going to take a look at is credit eligibility. As USDA lenders, comprehending the regulations that oversee our program is crucial for ensuring consistent compliance. Nonetheless, it is vital to acknowledge that the final decision-making power rests with each lender. Although adherence to regulatory guidelines is necessary, lenders possess the freedom to exercise their own judgment informed by their expertise and market insights. By staying well-informed about industry regulations and applying their professional judgment, lenders can correctly maneuver through intricate lending situations while prioritizing the best interests of their clients. In cases where a credit exception may be required, there are a few circumstances of adverse credit that a lender cannot waive, and those include previous USDA losses which occurred within 7 years of the loan submission date, delinquent non-tax federal debts, delinquent child support, and ineligible KVERS results. These are all not eligible for lender-approved credit exceptions. For GUS loans, GUS will decide the acceptable credit score for underwriting recommendations, including accept, refer, and refer with caution. For GUS Accept or Accept with full documentation, no credit score validation is needed. For loans that are manually underwritten without GUS, credit score validation is necessary. Lenders should choose the middle score from 3, the lower score from 2, a repeated score can be used, or the single score reported. If a credit report has no score, it must meet non-traditional trade line requirements. To validate the credit score for GUS refer with caution in manually underwritten files, at least one applicant whose income or assets are used for the loan must have a validated credit score. The applicant needs to have 2 trade lines on their credit report that have been open for at least 12 months, based on the account opening date shown on the report. A validated score does not mean the applicant has a good credit history. It only shows they have a minimum eligible credit history. Eligible trade lines for validating the credit score can include open, closed, or fully paid accounts, as long as there is a payment history. These can be loans, secured or unsecured, revolving accounts, installment loans, credit cards, collections, charge-off accounts, and more. The underwriter must review all collection accounts and determine if the applicant is an acceptable credit risk, regardless of GUS underwriting recommendation. USDA does not require medical collection accounts to be paid. If the cumulative total of all non-medical collections exceeds $2,000, you will need to either 1. Require payment in full of these accounts prior to loan closing, 2. Use an existing repayment agreement or require payment arrangements be made with documentation from the creditor and include the monthly payment, or 3. Include 5% of the outstanding balance as the monthly liability amount. No further documentation is required. All open collection accounts on the credit report must be listed on the GUS liabilities page. For the GUS data entry, collections that will be paid at or before loan closing should select the "To be paid off at or before closing" checkbox. If the collection is not required to be paid in full, the lender should select the Omit checkbox and provide an explanation in the additional data entry pop-up box to state why the debt will be omitted from ratio consideration. If a repayment agreement has a specified monthly payment, include that amount. Do not enter $1 in the monthly payment data field unless this is really the documented repayment amount. Rental history verification is not needed for GUS accept files. For refer with caution or manually underwritten files, a verification of rent may be necessary. Check the GUS underwriting findings report to see if a VOR is needed. All housing payments recorded in GUS must be properly verified and documented. Applicants without a verifiable housing payment history are not automatically disqualified. The underwriter from the approved lender must assess the available documents to decide if the applicant has a suitable credit history and meets program requirements. If there is one rent or mortgage payment that was more than 30 days late in the last 12 months, it is seen as significant derogatory credit and will need a credit exception. Applicants without a conventional credit history or a validated credit score can demonstrate their ability to meet debt obligations through alternative means. A non-traditional credit history alone does not justify a loan denial. Ultimately, it is the lender's duty to assess whether the loan aligns with agency guidelines and represents an acceptable credit risk, regardless of the GUS recommendation. For applicants with a 12-month verification of rent, 2 trade lines are necessary: the VOR and 1 additional eligible trade line from the credit report with a 12-month history or an acceptable non-traditional trade line. Applicants lacking a rent history must provide 3 trade lines, which can be a mix of traditional trade lines from the credit report with a 12-month history or eligible non-traditional trade lines. Non-traditional credit can be documented in several ways: a non-traditional mortgage credit report, self-reported trade lines on a traditional credit report, or documentation from third-party verifications, canceled checks, money order receipts, electronic payment records, payment histories from creditors, or bank statements that clearly show debit payments for services or products. An eligible non-traditional trade line must have a 12-month history and should not have been closed more than 6 months before the loan application. Acceptable non-traditional credit sources include, but are not limited to, rent or housing payments, utility services such as gas, electric, water, landline telephone service, or cable TV, provided that these services are not included in rent payments. Attachment 10A can be found in Chapter 10 of Handbook 13555. This is an excellent tool to help you during your underwriting review. The next key to eligibility we're going to highlight is ratio requirements. Ratios are derived from the repayment income as specified by the lender in Chapter 9 of the Handbook. The PITI ratio encompasses several components, including the first mortgage, any subordinate liens, homeowners insurance, supplemental property insurance, property taxes, the USDA annual fee, association or project dues for condominiums, co-ops, or PUDs, as well as other housing-related expenses. For the total debt ratio, applicants are deemed to possess the capacity to repay when their cumulative debt amounts to no more than 41% of their repayment income. The total debt ratio encompasses the monthly housing expenses in addition to any other monthly credit or debt responsibilities. The lender must document the applicant's debts using records such as credit reports, direct or third-party verifications, court documents, or deposit verifications. All open debts and accounts incurred through the closing date, including non-medical collection accounts and judgments, must be taken into account in the total debt calculation and documented in GUS and the loan application. The amounts on the credit report will be used unless there is verification for a different payment amount. If a different amount is used, the lender must provide documentation for the amount used and upload the documentation with the final submission to USDA. This slide outlines important considerations regarding liabilities. If you decide to omit a liability, ensure that it does not exceed 5% of the applicant's repayment income. For court-ordered debts, include the payment unless the applicant has been released from liability. If there are 10 months or fewer remaining on the payment and it does not exceed 5% of the monthly repayment income, it can also be excluded. Regarding student loans, regardless of their payment status, if the payment amount is greater than 0, use either the payment amount from the credit report or the actual documented payment. If the payment amount is 0, use 0.5% of the outstanding loan balance as shown on the credit report or through creditor verification. In community property states, the debts of a non-purchasing spouse must be included unless state law provides otherwise. The lender must reference the specific state statute in the permanent case file and ensure compliance with state laws. GUS files that receive an accept full documentation underwriting recommendation do not require a debt ratio waiver. Submissions that receive a GUS recommendation of refer or refer with caution and loans that are not supported by GUS must have documentation supporting eligible compensating factors to support a debt ratio waiver. The applicant's PITI ratio may exceed 29% and the total debt ratio may exceed 41% if the lender determines that strong compensating factors demonstrate that the household has higher repayment ability. The lender must document eligible compensating factors to support a debt ratio waiver. Agency approval of a lender's request may be granted if all of the following conditions are met. The maximum PITI ratio cannot exceed 32%. The maximum total debt ratio cannot exceed 44%. The validated credit score of all applicants is 680 or greater, and at least one of the acceptable compensating factors listed in Chapter 11 of the Handbook is identified. Those compensating factors include accumulated savings or cash reserves available post-loan closing are equal to or greater than 3 months of PITI payments. Cash on hand is not eligible. The applicants, which includes all employed applicants, have been continuously employed with their current primary employer for a minimum of 2 years. Applicants that have received Social Security benefits or retirement income for 2 years may utilize this compensating factor with documentation to support the history of receipt of benefits. This compensating factor is not applicable for self-employed applicants. The proposed PITI does not exceed the applicant's current verified housing expense by more than $100 or 5%, whichever is less, for the 12-month period preceding loan application. No more than one 30-day late payment for the previous 12 months. And lastly, the subject property is an energy efficient home based on the IECC standards. The lender is responsible for verifying and documenting evidence in the permanent loan file to meet this requirement. Next, we're going to talk about debt ratio waivers for refinance transactions. GUS files that receive and accept full documentation underwriting recommendation do not require a debt ratio waiver. Submissions that receive a GUS recommendation of refer or refer with caution and loans that are not supported by GUS require debt ratio waivers, and supporting documentation must be submitted to USDA. There is an exception. Streamline Assist refinance loans do not require debt ratio calculations. Therefore, no debt ratio waiver is required. Debt ratios for refinance loans are not limited to the maximum purchase debt ratio thresholds. The following are examples of acceptable compensating factors for debt ratio waiver requests for refinance transactions. A validated credit score of 680 or higher for all applicants. The proposed PITI does not exceed the borrower's current verified mortgage payment by more than $100 or 5%, whichever is less, for the 12-month period preceding loan application. Accumulated savings or cash reserves available post-closing are equal to or greater than 3 months of the proposed PITI payment. Cash on hand is not eligible for consideration as a compensating factor. Continuous employment with the current primary employer. The subject property is an energy-efficient home defined as a dwelling which meets or exceeds the current IECC. Refer to Handbook 1-3555, Chapter 11 for further information on what qualifies as meeting or exceeding the current IECC standards. For detailed information on waiver requirements and other ratio guidance, refer to Chapter 11. Now that we've covered the key points and updates regarding applicant eligibility, let's shift our focus to property requirements. Let's kick things off with a fascinating tidbit regarding USDA property eligibility. Did you know that a staggering 92% of the land in the United States is classified as rural? That's quite remarkable. If you've ever believed that your customer base is limited by the USDA's eligible areas, take a moment to consider just how much of the country qualifies for the Guaranteed program. Here is the property eligibility section on the USDA eligibility website. This page allows you to input a specific address to check if a home falls within an eligible area. Alternatively, you can navigate the map just like you would on Google Maps, enabling you to identify any potentially ineligible areas before you start searching for homes for your clients. When you zoom in for a closer look, the dark shaded areas show where the Guaranteed Loan Program cannot be used. Keep in mind that the eligibility site only checks if the home is in an eligible area. It does not assess if the home itself meets the requirements. An appraiser will make that determination. With the unique challenges rural areas often face when it comes to accessing affordable housing, buyers do have options beyond traditional existing housing. Condos, with their low maintenance lifestyle and shared amenities, have become increasingly popular among homebuyers, and they are eligible under the Guaranteed program. New construction is another great option. We are going to talk later on about the single close construction program. Maybe you are not currently offering the single close program, but that doesn't mean new construction isn't an option. USDA will also guarantee the end loan for new construction. And what about manufactured homes? Often underestimated, these homes have come a long way in terms of quality and design. They offer an affordable housing option for many individuals and families. By including manufactured homes as eligible properties, we not only support homeownership for a wider range of people, but also contribute to the growth of the housing market. USDA does not restrict the size of the site, but the property must mainly be designed, characterized, and used for residential purposes. It should also be typical for the area as shown by the appraisal and comparable properties. When looking at the appraisal, be cautious of buildings or land that generate income, as these are not allowed. Accessory dwelling units may be acceptable. The appraiser must decide if the unit counts as a second single-family home. The agency depends on the appraiser's expert assessment of the property's best use as a primary residence. Multiple parcels can qualify if they meet these conditions. The mortgage must have a valid first lien on each parcel. Each parcel must be fully conveyed and share the same zoning. The parcels should be adjacent unless separated by a road, and the remaining parcel cannot be developed. Additionally, the entire property should have only one home. The same rules apply to land. A hobby farm or garden is permitted, but the property must primarily be used, characterized, and appear residential. Land intended for income-generating activities will not be approved. USDA only requires one inspection for existing homes, and that is the HUD Handbook certification by the appraiser. No additional inspections are required by USDA unless required by the lender, appraiser, inspector, or state law. Please note that a safe water test is always required for properties with a private well. For more detailed information on property requirements, refer to Chapter 12. Our next key topic is the Guaranteed Underwriting System, also known as GUS, and the loan submission process. Time for another fact or fiction. I want to make sure USDA has all the documentation we used in making our underwriting decision, so it's okay to upload our entire case file in GUS. Is that fact or fiction? That is fiction. Please only upload what we need and set aside what we don't. Lenders sometimes upload an entire file to USDA, even if the documents are not listed in the Attachment 15A checklist. This makes our review slower because we have to go through extra papers to find what we need. We also notice that some documents needed for Attachment 15A are missing. Please check the GUS findings report carefully and send the necessary documents according to the 15A checklist. When you finish a GUS final submit, be ready to upload the required documents to prevent delays in USDA's review. All qualifying files must be submitted through GUS. We will cover files that are not required to be submitted through GUS later in the presentation. The most important thing to remember is that GUS does not underwrite loans. It is used to evaluate the credit risk of the borrower and does not replace the judgment of an experienced underwriter. GUS incorporates a modified version of the FHA total scorecard, but does not evaluate the dependability of repayment income. USDA counts on the lenders to make sure all file submissions have been reviewed by an underwriter to ensure they qualify for the guaranteed program. When a file is submitted, you are telling USDA that this file has been underwritten and meets USDA regulations as spelled out in 7 CFR 3555 and Handbook 1 3555 and the GUS findings. It's important that all information entered into GUS is accurate and matches the 3555-21 along with any other documentation submitted. GUS will return one of these underwriting recommendations: accept with full documentation, refer, or refer with caution. Review your findings. Even for a GUS accept, you must ensure it hasn't been randomly selected for a full documentation review. These files are randomly selected for a data integrity review. A refer or refer with caution require further review and will require a full document submission. Be sure to review your GUS findings report and submit documentation accordingly. Utilize the attachment 15A with all submissions. And remember, files that are incomplete will be released back to the lender, put on hold, and will create delays. Regardless of the GUS underwriting recommendation, you will upload all documents via the GUS application. For GUS loans that receive an accept underwriting recommendation, they require the least number of documents to be uploaded and submitted to USDA for review. These documents include the appraisal, the flood certification, Form RD 3555-21, Request for Single-Family Housing Loan Guarantee, which is filled out completely and accurately, and a few additional items if applicable, such as the non-purchasing spouse credit report and mortgage payoff for a refinance loan. There will be those occasions when you encounter a GUS accept that requires a full documentation review. This process involves the system randomly choosing GUS accepts for a quality assurance or data integrity assessment. If a file falls under the GUS accept with full documentation review category, the notification will appear on the findings report. Therefore, it's essential to thoroughly review your findings, even for GUS accepts. Now, for GUS accept with full documentation loans, please upload the following: Form RD 3555-21, the 1008 or similar form, the loan application, income and asset documentation, the credit report for a non-purchasing spouse if required, the mortgage payoff statement for a refinance loan if required, the flood certification, and lastly, the appraisal. Be sure to utilize the attachment 15A loan origination checklist. GUS refer files indicate that GUS has detected certain risk factors from the data provided. It is important to note that loans should not be rejected solely on the basis of the risk assessment produced by GUS. A comprehensive underwriting process must be conducted, and a complete documentation package should be submitted to USDA. Consistently review your findings report. A refer or refer with caution will typically indicate what issues were identified. This may include factors such as a low credit score, bankruptcy, or delinquent debts. Examine the file to assess whether the borrower is eligible for a loan through USDA before making the final decision. A scorecard finding usually suggests that there are several factors contributing to the referral, such as employment duration, length of residence, and limited credit history. It is essential to consider the entire file thoroughly before making that final submission in GUS. Now, for loans receiving a refer or refer with caution underwriting recommendation, please utilize page 2 of attachment 15A to determine what documents must be uploaded. Those items include Form RD 3555-21, 1008 or similar form, the loan application, income and asset documentation, the credit report, flood certification, appraisal, and if required, the credit report of a non-purchasing spouse, verification of rent, and mortgage payoff statement for a refinance loan. It is possible to receive an ineligible result in GUS. Reasons for this could include the property is not located in a rural area, the adjusted annual household income exceeds rural development guidelines, it is a non-owner occupied transaction, a borrower does not have acceptable citizenship or immigration status, an unacceptable SAM or Cabers check, or the debt-to-income ratios exceed the limits set forth by rural development and the borrower does not meet the requirements to qualify for a ratio waiver. If you feel this is an inaccurate determination, be sure to double-check your data entry into GUS to ensure your GUS underwriting recommendation is valid. The USDA LINC Training and Resource Library will be your #1 source for a wide range of helpful tools. You can find user guides that will guide you through processes like adding or modifying your organization's GUS security administrators, assigning GUS user roles, and submitting loan applications. These guides are designed with clear step-by-step instructions, so be sure to take a look at them. If you do find yourself having a technical issue with GUS, reach out to our help desk, either by email or phone, using the contacts listed on this slide. And the last topic we want to highlight today is our special initiatives. If you haven't explored these opportunities yet, they offer an excellent chance to broaden your client base. Let's start by talking a little about our combination construction to permanent loan option, also known as single close loans. Realizing we needed to find a way to expand housing options for home buyers, we developed a few pilot programs and one in fact turned into a permanent loan option, and that's our single close construction program, where the lender receives their guarantee from us before a shovel even hits the ground. This option not only makes new construction an affordable option for low to moderate income households, it also benefits the lender, real estate agent, builder, and the local community. Let's take a look at the basics of lender requirements. After obtaining USDA approval, lenders can submit a request for conditional commitment, which allows them to self-certify that their staff has at least 2 years of experience in handling construction loans. Alternatively, a lender may choose to hire a construction loan management firm that has a minimum of 2 years of relevant experience. The lender is responsible for verifying the eligibility of the chosen company. Additionally, it is essential to confirm the eligibility of the contractors and builders involved. For a single close construction, the key responsibilities of the lender include approving builders, overseeing disbursement of loan proceeds, monitoring the construction of the subject property, obtaining documentation confirming construction is complete, and ensuring use of fixed-price construction contract. Yet another challenge with the lack of affordable housing is that much of the existing stock is in need of repair to be safe and sanitary, and sometimes the repairs are significant. And that is the basis for the creation of our Rehabilitation and Repair Program. Very similar to the single close construction, this product allows for lending up to 100% of the as-improved valuation, provides for a single closing, allows escrows for contingency funds and loan payments. Most importantly, the loan note guarantee is issued at signing prior to any work beginning. And also like the single close, it pays the real estate agent fees at signing before any work begins. If the loan will be approved based on repairs to be completed after closing, some restrictions apply as outlined on this slide. A separate detailed training on single close construction and rehab repair programs is available in the LINC Training and Resource Library. If you are interested in learning more about how your organization can benefit from offering the single close construction loan, scan here to download our single close fact sheet. As mentioned earlier, manufactured homes are often underestimated. These homes have come a long way in terms of quality and design. They offer an affordable housing option for many individuals and families. By including manufactured homes as eligible properties, we not only support home ownership for a wider range of people, but also contribute to the growth of the housing market. For manufactured homes to be eligible for USDA, they must have a site that conforms to state and local standards, be a new unit in stock that has never been installed or occupied at any other site or location, have a floor area of not less than 400 square feet, be placed on a permanent foundation, and meet or exceed the FMHC SS standards for the geographic area the unit will be placed. Now, if a manufactured home exhibits any of the following, it would not be eligible for USDA. The purchased unit is moved from a site other than a dealer's lot, the unit is older than 12 months from date of the purchase agreement, or the unit has a tow hitch or running gear remaining. The chart shown on this slide is available in Chapter 12 of the Handbook. It provides documentation options available to evidence certified plans and specifications, construction inspections, and thermal standards were met for manufactured homes. The lender is responsible for obtaining one form of required evidence from the list of available source options in each category. This evidence must be kept in the lender's permanent loan file. For additional guidance, please review Chapter 12. USDA is dedicated to eliminating obstacles and exploring new avenues to increase affordable housing options for rural homebuyers. Many regions still face a lack of reasonably priced traditional homes on the market. Acknowledging the advancements in the quality and design of manufactured housing, as of May 5, 2025, buyers may now consider existing manufactured housing as another great option to choose from in all states. When considering existing manufactured homes, note that the home must have a manufactured date that is no more than 20 years old from the date of loan closing. Lenders must also ensure that units have not undergone any alterations or modifications except for porches, decks, or other structures that were constructed according to engineered designs or received approval and inspection from local code officials. Additionally, all other requirements outlined in the regulation and handbook must be met. For more information, refer to Chapter 13 of the Handbook. Congratulations! You completed the Lender Recertification course. Before you leave today, let's quickly review the resources available to you. Your number one destination for origination and servicing resources and guides will be the USDA LINC Training and Resource Library. You can also find our turn times for conditional commitments on this page. This site provides a tremendous amount of knowledge. Bookmark it, save it as a favorite. You will visit it frequently. Be sure to sign up for GovDelivery email updates if you haven't yet, so you never miss important updates from USDA. You can register for GovDelivery from the link on this page. The program's technical handbook enhances understanding of the regulation and offers further insights. Known as Handbook 1-3555 or simply the Handbook, it consists of 19 chapters. The guidance provided within this handbook is designed to complement the regulation, not to substitute it. For the fastest access to the information you need, you always want to refer to the handbook first. Before handbook and policy updates go into effect, you have an opportunity to review and comment on proposed changes. On March 5, 2024, USDA announced the launching of a new online tool. The new tool, known as the Single Family Housing and Guaranteed Loan Program Policy Desk, allows lenders and stakeholders an opportunity to provide valuable feedback on proposed policy changes for the Single Family Housing Guaranteed Loan Program. Advanced copies of proposed policy changes are posted to this page of the USDA LINC Training and Resource Library. We encourage all lenders and stakeholders to utilize the policy desk for review and comment on all proposed policy changes to rural development. Make sure you are signed up to receive GovDelivery notifications so you can share your feedback regarding upcoming policy changes with us. An additional valuable resource developed by our policy team is the FAQ document. This compilation includes insightful questions posed by lenders that necessitated a deeper understanding of how the regulations and handbook policies pertain to specific situations. The document features excellent examples and some quite unique scenarios. We encourage you to take a moment and review it. If you still have questions after going through your resources and tools, don't hesitate to ask. Our single-family housing guarantee team is always happy to assist you. Depending on the topic of your question, reach out to the appropriate guarantee team for assistance. We want to express our gratitude to everyone for reviewing this lender recertification training course. Your partnership and commitment to helping rural residents achieve their homeownership dreams is greatly valued. As a reminder, the last part of the training involves a knowledge quiz. If you haven't received the link from your organization's point of contact, please reach out to them to ensure you can complete this final training step. Thank you again and have a great day.